Introduce myself. I forgot to do that. My name is Eric Mokaya. I'm the founder of Mwango Capital. Usually we do Twitter Spaces, but today I think we partnered with Jubilee to make sure that we do a webinar. I think so. Welcome to the webinar today. A few housekeeping rules. We'll have a presentation. So I think the order of today is that we have a presentation from Jubilee, and then we'll get into the Q&A session towards the end. We'll set aside quite a bit of time at the end because we received a lot of questions beforehand, and we'll delve into as many of them as possible. We have a little bit of leeway. We may extend a little bit by 10 minutes. So keep the questions coming. So we are monitoring the chat as quickly as possible. Keep the relevant questions coming in, and we'll definitely deal with them. So I'll just hand over. Could you set up that presentation as quickly as possible, and then we'll get started. Yes. So Cliff, you think you'll take us fast through the presentation and then give us a bit of brief on that, and then we'll get to the Q&A at the end. Cliff and Rita, I think, together. All right, go ahead, Cliff. Now give us a bit of a context to the war and then where we are so far.
All right, thank you, Eric. So I think the last 3 months have been extremely volatile. At the beginning of this year, the outlook was quite optimistic. So that was in January, going into February. The outlook on the global economic growth, regional growth, as well as Kenya's growth was quite optimistic. And this is on the back of a recovery from the global pandemic. We had started seeing a bit of stability. Fast forward to 28th of February 2026, President Donald Trump launched Operation Epic Fury, which was basically a military operation targeting Iran in conjunction with Israel. We saw a heavy military operation in most of March going into April, where we saw the supreme leader of Iran, Al-Khamenei, being killed alongside other officials. Iran retaliated with strikes on U.S. embassies, military installations, as well as oil infrastructure in the Middle East. And that really introduced a lot of volatility in the global macroeconomic outlook, as well as performance of investment markets. Fast forward to April. So on April 8th, we saw an announcement of a 2-week ceasefire. This was brokered by Pakistan. However, this was immediately strained with Iran refusing to reopen the Strait of Hormuz. And this was due to the strikes by Israel on Lebanon. So in retaliation, President Trump announced a naval blockade, which has resulted into a stalemate. So as it currently stands, the long and short of it is, the ceasefire is quite fragile. The communication is very uncertain in terms of the direction we are taking. I think there's a lot of changes that we are seeing with regards to where everyone's goalposts are, and there's clearly a lack of trust across the board. So it's a very volatile situation, and as my colleague Rita will point out, we've sort of tried to come up with different scenarios with regards to what we are likely to see happening. So before Rita comes in, I'll just make a few comments, and moving on to the next slide. So what our key concern is mostly is there is a bit of misplaced optimism about an early resolution to the conflict. I think that's been a major risk. Initially, we had anticipated that this would be, a short-lived conflict that would last maybe about a duration of 3 months. I think next week we are now hitting the 3 months mark. We've seen commodities such as crude oil rise as high as 55%. So the price change, we've moved from a price of about $72 per barrel to as high as $120, which has been a great disruption. The likes of liquefied natural gas, we've seen prices go as high as 60%. And key to note, this region is critical because about more than 20% of crude moves through that region. About 30% of liquefied natural gas is coming from Qatar, and I think production has been significantly disrupted. And if you look at things like commodities such as urea, which is a key component in fertilizer, a huge chunk of that is also coming from that region. So there's a lot of disruption that is yet to hit our market, in our view. And we are seeing, in comparison to previous conflicts such as the Russia-Ukraine war, which had a greater impact on markets such as Europe and well as Asia. This is having a greater impact across the globe, right? So we are seeing a lot of changes coming our way, and subsequently in this discussion, we'll highlight some of the anticipated impacts across different regions, but also across different markets. So that really sets the scene of what's happening. And I think we'll get into the presentation, starting off with a view from a global point of view, bring the discussion all the way to Kenya, or bring it home. Thank you.
Okay, so I'll pick it up from here. So looking at this particular scenario framework, we are currently seeing that the market is currently pricing our base case. So Brent is currently at 108 levels. The future curve is pricing today's barrel higher than next year's. The implied volatility is elevated, but it's not yet as extreme. And all of that is consistent with the 55% scenario that we've indicated, and not the mild or the severe tails. So the implication of this is that we are not really being paid to take the mild scenario as a working assumption. So the market has especially on the severe tail. The 20% probability that we are seeing is not negligible. So the cost of hedging is currently reasonable because volatility hasn't really fully priced in the tail. But in our view, that window won't stay open if the Hormuz continues to deteriorate further. So if we look at the global forecast, moving on to the impact on the global front, starting off with the GDP. At the start of the year, I think the forecasts, we had the IMF forecasting the global growth at around 3.4%. So we are looking at a compression of around 2.1%, and that's a full percentage point lower. So one percentage point of global growth, I know it might sound clinical, until you see it with what it really implies. So if we look at it in terms of numerical figures, this is roughly $900 billion of foregone output. And if we now drill down into the composition, only 50 basis points come from the oil price itself, 40 basis points come from the tighter financial conditions, and the 20 from the confidence effects. So in other words, the policy response and the market reaction, you see, they're doing more damage than the underlying physical shock. And the conditions under which, in these particular conditions, it's what now the central banks tend to make it sort of worse. So if, the textbook, we usually call it as a policy regret, holding too long because inflation credibility matters more. in the moment than the growth cost that arrives in a lag. So we have been here before in 1979 to 1981, the late 2007, and this pattern is recognizable. So if we look at the impact of this in terms of inflation, the rates, and also the financial markets, so we see the divergence really in April, as we have highlighted on the slide. I think it's the cleanest evidence that we have something that has structurally shifted. See, the equities absorbed the shock. The S&P was up over 9% in the month, and Nikkei up over 14%, but the bonds did not. So if we look at the bond market moves specifically, because I think it's sort of unusual, since the war began, the US 10-year has risen from roughly 4.25% to around 4.6%, I think. That's like at 35 basis points wider in a geopolitical conflict, But from a theoretical point of view, they say the yields should be falling at the moment. If you look at the UK 10-year, it's up around, 27 basis points in April alone. Canada, same thing. The Eurozone, same thing. So every major developed market sovereign yield rose during this particular conflict and in unison against the historical pattern. So what we are currently seeing here is that they're not falling because we're not seeing here, it's not falling because of the inflation expectation. No, they're actually falling because of the inflation expectation channel, which is quite overwhelming. It's overwhelming the flight to quality channel. So the safe haven flow, we can see it went into dollars instead. The US dollar index, it's quite firm. The gold is bid but secondary. The emerging markets had currency spreads have widened materially, as we see. All this now translates, or rather goes back into the central bank. So what this slide really argues is that the policy calendar has been pushed out by a full quarter, possibly two. The June Fed meeting and the July ECB are not currently pricing in any further cuts. Even the September Fed, which markets had assigned a high probability of a cut at the start of the year, now carries around roughly 40% hike risk. So the terminal rate has shifted up to 50 to 100 basis points across the developed world. So in overview, now the cost is now being borne by the emerging markets first. So they cannot ease while the Fed holds. We saw Egypt paused on the 2nd of April, Kenya paused on the 8th of April. So we are seeing sort of a chain that is flowing from Washington to Cairo to Nairobi within a matter of weeks, and it's barely into the quarter. So if we move now into the region, the sub-Saharan market. So the ranking here on this page is not a new analysis. We have known for years which countries sit where in terms of import dependency, the reserve curve spectrum. So what is new is that this shock is now testing the rankings in real time, and the ordering is sort of holding. So if we look at markets like Egypt and Nigeria, because they're sort of showing how differently the same shock can land. So if we look at the Egypt market, which I think is the cleanest importer story, so the current account is widening by roughly $1 billion a month through year end on high energy, higher food, the weaker Gulf remittances, and also the softer tourism. So we have raised our deficit forecast around 4.5% of GDP for the financial year 2026 and 4% for the financial year 2027. Inflation forecasts are up to around 13.5% for the financial year 2026 and 14.7% for the subsequent year. So that's around a 4 to 6 point upward revision in just 12 months. Reserves are currently at $53 billion, which is a real strength. But a follow on the IMF program will likely be needed if pressures persist. So we are constructive on Egyptian hard currency debt at current spreads, but our eyes still remain open to any further deterioration in the markets. Moving to now the Nigeria market, which I think tells now an opposite story. So Brent, which is currently at 108 levels, which is well above the budget benchmark at $64.85 per barrel. So the Naira is stable at 1350 to 1430, reserves at 50 billion. The current account surplus is heading to around 17 billion based on forecast. And our view is that this is not yet a pure oil call. So the dollar strength, and this is because of the dollar strength, the imported inflation, the Gulf remittance stress, which gives some sort of windfall. So in terms of our view, we hold Nigeria as being a neutral market. So if we move on to now trickling all this into now the impact of this Middle East conflict on Kenya. So if we look at the pre-shock baseline as the comparison point, inflation was at around 4.3% in February. The policy rate was cut 9 times consecutively to 8.75%. The shilling has held steady at 128 to 129. And then, so we can see that the disinflation cycle was actually working, and also the rate cutting cycle was also working alongside with it. And then April broke that. So the headline inflation we saw in the month of April jumped to as high as 5.6%, which I think is the highest reading in 2 years. And I think the composition of this matters more than the level. So if we drill down into the components, we see that the transport inflation went from 3.8%, from 3.8 to around 10% in a single month. Food inflation accelerated to around 8.8%, and it carries 33% of the basket. Housing and utilities around 16, and then we have transport at around 10%. So cumulatively, all these totals to around 58 of the basket, which is now being directly exposed to what just moved. So this is one of the major reasons why the print rose to 1.2 percentage points in a single month, and it shouldn't come as a surprise. So based on this, we saw the CBK pausing the cutting cycle on the 8th of April, and we also saw the Banking Association, publicly urging them to hold at 8.75. So this sort of alignment, between the regulator, the banking sector, and the data, it sort of tells you that the easing cycle is now on pause, and for at least one more meeting, probably 2. But we'll be able to know in the next monetary policy meeting coming June. So how this all trickles down into the macro. So our base case has Kenya inflation at around 7%. The policy is around 9.25%. The shilling depreciating 5 to 10%. The fiscal deficit at around 6 to 6.8% of GDP. Reserve cover dropping to around 3.5 to 4 months. And then the Eurobond spreads widening 150 to 300 basis points. So I think this is the most, or rather what is the most important factor about this set of projections is not whether this sort of comes true. I think it's the fact that they sort of reinforce each other. Like a weaker shilling makes the inflation print worse. A worse inflation print forces the policy rate higher, a higher policy rate tends to widen the spreads, and this the feedback loop is what we are now being positioned for. So none of these moves are sort of big in isolation. Together they sort of reprise the entire local currency curve and also the hard currency complex.
All right. So thank you, Rita, for that. And I'll try and bring the discussion home. And we've tried to sort of paint the general picture in terms of what's happening globally and within the region. And this is such a big discussion to really fit within the time we have. But in a nutshell, what we are seeing is there is sort of a structure shift. And as earlier mentioned, this is dependent on how long it will take to resolve this conflict. Initially the sentiment was it would be short-lived, but given the way things are evolving, it's sort of looking to be a bit prolonged than we had initially anticipated, or than we had initially sort of desired. So I think that's one factor the market or investors need to start making. They need to start coming to terms with. So, the optimism about an early resolution needs to be managed. Number two, we are just starting to see the impact. And as my colleague Rita alluded to, this impact is now starting to show in prices of local commodities or local goods and that we consume every day. So this is now changes in inflation. So we've started seeing inflation edging higher, and as expected, that is sort of the first indicator in terms of the transition. And this is all being driven by the increment or the increase in fuel prices due to the disruption that has happened in crude oil. So going back to the impact, I'll try and focus the discussion on three key things. One, there's definitely a structure shift in how investors think about risk. Earlier in the year, it was sort of a bullish attitude or sort of a risk-on attitude when we think about risk. That is likely going to evolve into maybe a bearish or a more pessimistic view about risk. And I'll talk more about that. The second structure shift is around inflation. Inflation is a major driver of so many things when you think about the economy. Number one, inflation sort of informs how much we have in our pocket as disposable income. But it also informs central bank policy. And as long as inflation is low, that usually supports the central bank to maintain a low policy rate, which translates to low interest rates in the economy, which sort of supports lending and growth, right? With inflation rising, that sort of tilts that projection. And now you start seeing central banks sort of holding cutting rates. And that also increases the likelihood that central banks might also consider increasing rates. But the third structure shift is mainly around globalization, right? For the longest time, we've heard about, geopolitical risk. We've heard about deglobalization. But a key factor to note is there is now a higher risk premium that is likely going to be demanded for taking geopolitical risk, right? So what I mean here is, let's say you are an investor, say in Kenya, and you are looking to export to the Middle East, right? Or you are looking to do business in Europe, right? The disruption that is happening sort of makes you hold back on these plans. Similarly, for an investor who's in the Middle East or an investor in the US or in Europe or Asia that was planning on doing business across the globe is likely going to demand a higher premium to sort of compensate for this risk. So, prices of insurance are likely to go higher. Prices for transportation or logistics are likely to also go higher. So there's disruption across those three structural factors, that being risk, inflation, as well as globalization. So in the short term, our expectation one is, of course, there will be a higher geopolitical risk premium demanded by most investors. In the short term, we expect persistent commodity price volatility. So the movements in oil prices, the volatility that is expected to sustain in the short term. We also expect elevated inflation uncertainty, which would likely also put pressure on interest rates, both locally but also globally. We are likely to also see delayed interest rate cuts. If you recall, the US Federal Reserve had started a series of interest rate cuts, but as it currently stands, the expectation is we might not see a cut in 2026. And if inflation goes higher, then that might also put pressure on increasing rates to sort of cap that inflation. Similarly, that might happen also locally if inflation sort of goes outside of the central bank upper band of 7.5%. In addition to that, we are likely also to see a stronger bias for USD denominated assets. And I'll talk more about some of the assets that are, or some of the investments that are likely to be preferred. But we're also likely to see higher spending on defense, right? Everyone is sort of taking a defensive view, given what's happened in the Middle East, what's happened in Eastern Europe. So there's likely going to be increased expenditure. So who are the strategic winners in this environment? Number one, we are seeing energy producers sort of being your strategic winners. And we've seen the likes of investors like Dangote sort of benefit from the higher energy prices. So energy or oil exporters are likely strategic winners, but also oil importers are also likely to suffer in this environment. Defense stocks or defense companies also positioned to benefit from this environment. As earlier mentioned, also commodity exporters. Players in infrastructure, I think, are also likely to benefit from this environment, as well as logistics players, as they sort of reprice to price in what has happened. Strategic losers in this environment, you're looking at oil importing emerging markets. And here you're likely to see a lot of inflation being imported through fuel. Consumer discretionary stocks, those are also likely to be impacted. Airlines, tourism, travel businesses are also likely to be impacted. But also countries with weak external balances or countries that are heavily dependent on external financing are likely to also be impacted. So that's what we are seeing in the short term, right? I'll speak briefly on the long term. And yes, so this is more of a discussion. I think in the long term, focus is likely to shift more to assets that maximize resilience, as well as assets that minimize volatility, right? So whereas in the beginning of the year, we had sort of a bullish stance in terms of asset allocation, your long-term investors tend to prefer a bit of resilience and minimize volatility. So we've had a series of events ranging from the pandemic, the Ukraine-Russia war, and now we are talking of the US-Israel-Iran war. So these disruptions, it's not a cyclical effect. It's becoming structural in nature, right? It's not something that, 6 months from now, we will sort of say, this is behind us. We are likely to see a structural effect on economies, but also in different assets going forward. So certain factors start becoming structural investment themes versus sort of cyclical trades. So factors such as energy security, I think that is something that we will likely keep hearing a discussion being had. And this is now becoming more pronounced given how vulnerable most emerging markets are. So you're likely to hear more discussions around becoming energy sufficient or sort of reliant on your own capabilities. Another factor is around defense capabilities. So everyone is looking inward. Are we spending adequately on defense? So you're likely to hear of investments in things like cyber defense, investments in things like military AI or military artificial intelligence, a lot of investment in intelligence technology, semiconductor security. So everyone might push for more reliance on their own capabilities versus relying on other players. Another factor that is also likely to become pronounced in the long term, and I think the discussion is already being had, is around supply chain resilience. We've seen that disruption happen over the last 5 to 8 years since the pandemic, and we are likely to see more investment towards supply chain resilience. I talked about cybersecurity. I think that's going to be more pronounced going forward. Strategic infrastructure, things like, energy, water infrastructure. We saw the destruction that happened in the Middle East to water desalination plants. Investment in things like ports. You're likely to see more investment in strategic infrastructure in the long term. Basically, domestic industrial capacity is also going to be a focus, right? In the long term as well, more allocation to real assets. So, things like commodities, infrastructure, and maybe even equities or stocks that have pricing power. So these are companies that have the ability to pass on the shock to consumers without necessarily impacting their demand. I talked about defense. I think that's no longer sort of a cyclical discussion. I think it's going to be around for the long term. You're likely to also see in the long term greater allocation to private markets, especially by long-term investors. So you're talking about, infrastructure assets. You're also likely to see, inflation-linked securities also become popular. So things like inflation-linked bonds. Geographic diversification is likely to become more strategic, right? So in this case, you're likely to have allegiances either to the US or allegiances to China, right? So the West or the East, sort of more allegiances are starting to creep up. And that will indirectly impact policy within different markets. So that's the kind of the globalization that we're also talking about. Of course, the energy transition is also going to accelerate. More discussions around renewable assets, battery storage, discussions around domestic energy independence, nuclear energy, etc. So that transition is also likely to happen. But as I conclude, you're also likely to hear discussions around reserve diversification. So things like, where are your reserves? Are your reserves purely dependent on the US dollar? Or are we likely to see now countries sort of build up reserves around gold as a commodity? So you're likely to hear discussions around de-dollarization and demand for sort of neutral reserve assets. But lastly, I think the conversation around AI and automation is likely going to remain pronounced. and it's now becoming more of a geopolitical investment. So investments in AI infrastructure, semiconductors, robotics, industry automation, etc. So there's definitely a shift that will happen, but that sort of gives a picture both in the short term as well as the long term with regards to what we are likely to see. So, Eric, I think we'll pause there in the interest of time. I think as Ali alluded to, it's a very long discussion, but really that's the long and short of it. Thank you.
All right, Cliff, thank you so much for taking us through that comprehensive view. I've seen a couple of questions asking about the slides. The slides will be available to the emails that you used to register for the presentation, so we will definitely send them in. And a few people are asking whether we can break it down a little bit to the common wananchi in terms of key takeaways that we can. So perhaps I'll give that to Cliff, perhaps to just give a brief overview on what is expected from the wananchi. The wananchi sees fuel prices going up. Perhaps they relate them a lot to government policy, but then there's also a little bit of impact from the Middle East. So could you contextualize that for someone who's maybe been listening and is listening to us talk about basis points a lot? Can you break it down for us, a few things that they need to pay attention to as regard the Middle East?
Yeah. So I'll try and maybe break it down as you've requested. So by nature and specifically talking about Kenya and East Africa as a region, fuel is a major commodity that is comprised within our import bill, right? So this is a fuel that we consume in our vehicles, but also the fuel that powers industries, be it diesel, be it kerosene, be it petrol. So we are a major sort of importer of that commodity across the region. And basically what has happened in the last 3 months is a major producer, which is Middle East, has been disrupted by the war. So about 20% of global oil produced goes through the Strait of Hormuz, which is very close to Iran and surrounding regions such as Qatar, UAE, right? So that disruption has reduced the amount of oil that is available in supply. And whenever there is limited supply of a commodity, what usually happens is prices start going up, right? So to a larger extent, what we are seeing happening domestically in terms of fuel prices going up is not just isolated to Kenya. I think it's happening globally, and it's been majorly driven by the disruption we've seen in the Middle East. So that's the reality of what is happening. So higher fuel prices, what does that mean? Fuel is a key component in production. So things like diesel, power, up translates into higher prices of other commodities, right? So here we are talking about things like if I talk about things like transport, right? We are likely to see higher transport costs or fares. If I look at energy prices, there's also a likelihood that could come under pressure. But also things like fertilizer could also come under pressure, the price of fertilizer, which is a key component in the agriculture sector. So that might also put pressure on food prices indirectly, right? So whenever all these prices go up,